Anubhav, hi, good to have you with us. How have you been?
Hi, great to be on the show, and thanks for having me.
Anubhav, I've been, this is an interesting conversation. I'm genuinely looking forward to this conversation. Given the context that we're in, right? There are many things that you're doing, and possibly one of the first ones to sort of do that, right? For example, embedded finance is something that you're kind of championing, right? And you're working with many
Yeah,
partners. But I think more
yeah,
importantly, what you're really doing, which I'm looking forward to in our discussion, right, is creating an alternate system, right, which is outside of very typical platforms that we've been dependent on, right? From a credit extension standpoint, right? Our ability, right? And here you're creating a completely independent parallel structure, right? With of course a little bit of an influence from civil like factors, right? But largely dependent on very functional aspects, right? Of a certain business, right? Where you're essentially evaluating the health and the possibility of growth, so on and so forth, right? And I think that's a far superior mechanic rather than being dependent on the mechanics that have been set up, right? Because they just are very limiting in many ways, right? And that makes our conversation very interesting. Anubhav,
absolutely.
before we dive into our session today, right? I'd love you to take us through your background. A quick round of introduction will be helpful, and from there we start talking about your Rupifi journey.
Sure, absolutely. So I think to begin with, I have always been a credit risk person. Started off with American Express, did
Sure.
5 years of commercial risk, consumer
Right.
risk, did a lot of financial underwriting for small businesses. This was for the US market.
Right.
Learned a lot about how the small business risk
Uh-huh.
is quite different from a consumer risk,
Right.
right? How do you really look at various factors than
Sure.
just the ability of a consumer or a retail customer to earn a salary at the end of the month?
Right.
It's much more than that.
Mhm.
So there's a lot of volatility, there's a lot of fluctuation in
Right.
and seasonality in
Right.
their cash flows. So that was the starting point, and I think a good learning in the beginning of the career. And then I was also involved at an other extreme end. So while
Mhm.
Amex is known to be looking at super prime and very premium customers,
Right.
couple of years I worked at EXL
Mhm.
for Citibank, where we were looking at subprime customers.
Okay.
So I was leading underwriting strategy for subprime
Right.
uh, for City cards. So
Mhm.
that gave a good mix of all sorts of risk management practices that are being followed globally in
Right.
terms of how do you look at the very good as well as the not so good customers,
Sure.
and you still make money on both those
Right.
segments, right?
Right.
There is enough money to be made. So the whole core fundamentals of risk were set up through those 7 years that
Right.
I had. Did an edtech startup in the middle. I realized education was not my cup of tea. We sold that company, and I thought I should rather stick to financial services because that's where I enjoyed the most. I did well
Right.
during my risk experience, and then started this consumer lending startup called Cubera,
Right.
uh, where we were building a managed marketplace for salaried unsecured personal loans. That was a great experience. 3.5
Right.
years at Cubera, building it from scratch, working with the top banks in the country,
Right.
building a large loan book,
Mhm.
very profitable unit economics. In fact, unit economics wise, we were positive right from very early on.
Right.
And then the company obviously getting acquired by a large group called Incred.
Sure.
Uh, then a short stint in the middle where I was trying to figure out what I wanted to do next.
Right.
What was driving, what would drive my next 5 years, 10 years of
Right.
passion. So I did a short stint at Razorpay.
Mhm.
Uh, Obviously, Razorpay is a great company to be a part of. I always wanted to see how companies build good culture, how companies build product first,
Right.
technology first kind of processes. I was heading lending for them, but somewhere I think I realized initially only that I'm better off starting something of my own rather than
Right.
working for Razorpay. Even though I would say that Razorpay also felt like a startup of its own,
Right.
because within Razorpay I was looking at Razorpay Capital, which was a completely new team. I was the first
Right.
person out there, and
Interesting.
and the founders had told me that, hey, run it like you're running
Right.
your own company.
Right.
Uh, but still, I think I wanted to do something right from scratch, and that's where we started looking at the SME space in more
Right.
detail.
Right.
Uh, I mean, it's my hypothesis that, or it's my belief that in India today, consumers are still well served.
Right.
There is a lot of innovative and disruptive work that is being done by startups and
Sure.
by the technology world for retail customers. But when it comes to SMEs, that's where the true potential lies, that still underserved, even though you have companies trying to solve B2B and solve SME related work. But I think there's still a long tail of SMEs who still don't get access to financial products. I mean, access is a problem, not the quality of experience. I think in consumer, access is not a problem. The experience is what everybody is trying to change. But in SME, it's the other way around. So that's where me and a couple of my current co-founders, Ankit and Javed, who I met through a common friend, we did brainstorming for close to 1.5 years, and that's how Rupifi started. Yeah.
Very interesting. Anubhav, I'm gonna ask you to tell us a little more about Rupifi, right? What's the construct? I mean, you highlighted SMEs, right? I mean, I know how differentiated you are, right? But I would love you to sort of put it across, for people who are going to be watching this, right? I mean, it's going to be easy for them to kind of understand the mechanics of Rupifi.
Sure. So I think one thing was clear when the three of us, Ankit, Javed, and I, we were sitting and brainstorming that SME was the target segment, but that's a very, very large segment.
Right.
If I say SME, especially in Indian context, it's a bit funny that the MSME definition that the government has puts 100 crore turnover business also as an MSME and puts a couple of crores turnover business also as an MSME, right? Now you can't build the same product for both. These are two very, very different entities. So what we decided is that, hey, we are going to focus on, let's say, a sub 5 crore turnover or a sub 10 crore turnover, kind of the medium and small size businesses.
Right.
Because if you see today, traditionally, most of the incumbents, whether it's banks, NBFCs, even fintechs, they have a balance sheet based underwriting approach.
Right.
They try and assess any kind of working capital need or credit need based on the overall assessment of the balance sheet and the profitability of a small business.
Right.
Now that itself derails the process, because in India, 75 to 80% of businesses don't have a balance sheet. Right. Even if they do, it's grossly underreported because most of the business is in cash. So that's not really reflecting in their P&L or in their balance sheet. Right. So I think what is very important for us to do is move away from a balance sheet based approach till the government comes up with more such initiatives like digitization of all the transactions and e-invoicing becoming mandatory so that every single transaction is now recorded. But till that happens, I think it's very important that we move away to a cash flow based approach rather than a balance sheet based approach. Right. And I think that's where we thought that, hey, if we are to do cash flow based underwriting and if we are to go after the smaller SMEs, we need to reduce costs. We need to completely remove acquisition costs. We need to find a large distribution channel where we can embed inside that channel, be a integrated partner so that the data comes to us, the costs are reduced, and we don't have to worry about collections and repayments the way a traditional lending company worries, right? So to look at, in a summary, basically, we decided that there are B2B transactions or small business transactions that are happening today, which obviously require some kind of working capital support or credit support. Why can't we be there at the source of that transaction and underwrite that transaction? So I will not underwrite the SME. I will underwrite a transaction, right? And then power that transaction through a completely digital solution. So I think that was the approach that we will start working with some of the large players. There are plenty of such players in India who work with like hundreds of thousands of SMEs. We just go there, embed ourselves into their system, take data, underwrite that transaction that's happening on their system, and power it through credit. Balance sheet wise, it's still powered through traditional banks and NBFCs, right? But from a demand side, from a target segment wise, it's all through a embedded lending model.
Very interesting. Anubhav, tell me this, right? So, when you're doing that, is this like a point-to-point funding, or is this like a line of credit that you sort of you extend to these these say suppliers, right, who are catering into say large clients, right? And I think before I ask you that, right, or before you answer that, it'll be lovely if you could give me a construct of, say, one of your relationships that is out there. I mean, I know of a relationship that you
Sure.
have. Right? If you
Sure.
could spell it out, I think it'd be amazing
Sure.
for us to then put everything in context.
Sure. So let me take an example, and so we have a partner called Find, which is a B2B fashion marketplace. So what they do is Find actually caters to tier 2, tier 3 fashion retailers. So multi-brand outlets, small fashion shops, apparel shops, footwear shops, which are there in these kind of shops which we had actually shopped from during our days. I mean, we never used to go into a branded showroom. We always used to go into a shop where we used to ask a retailer to show us, let's say, apparel or shows from multiple brands, right? So that kind of a retailer who's in a tier 2, tier 3 town, the typical problem they face when they interact with an offline distributor today is that there are minimum order quantities, there are minimum order volumes. So what Find is doing is completely changing that and saying that, hey, a small retailer can even order one pair of shoes or two pair of trousers from a brand directly through them. And what we are doing is we are giving the retailer a credit option. Because the retailer thinks more than 2 or 3 times before ordering a new brand or a new kind of a product. But they have to do it because how do they grow their business? Right. If they continue to stock the same kind of material, they become obsolete and they become redundant over a period of time. Especially with online marketplaces and platforms offering such a variety, it's very important for even a small retailer to start showing that to the customer or the footfall that they see. So Find actually tries to answer that, but the problem was that even though they were having that variety on their marketplace, the retailer always had this challenge that how do I stock everything? I can't buy, I don't have enough capital, I don't have enough money to stock everything. So we provide a credit line to that retailer that up to, and we assess his historical transactions on Find platform and see that, okay, this retailer is typically shopping for, let's say, 50,000 worth of products or a couple of lakhs worth of products on a monthly basis. Can I give them that kind of credit limit? And now he can buy the stock Find, use, let's say, a 30-day credit period, sell that product. Once he receives that money, he can pay me back. Right. So it's a complete, cash flow projection and cash flow based lending, where instead of looking at his bank statement or instead of looking at his financial statement, we don't ask for all that data, right? We purely go and talk to Find, go deeper into their systems, try to understand the order history of every retailer, and basis that on an instant level, give him a credit. So imagine it this way, Ashu, that there is a retailer, he comes to Find, he selects products, he goes to the checkout page, he sees net banking UPI, he knows he doesn't have enough money. He sees Rupifi as a credit option, he selects that, and boom, the transaction goes through and he can pay after 30 days.
Very interesting. Anubhav, I'm going to, there's something that I want to ask you around the SME mindset complexity, right? I mean, if you look at SMEs, right, they've largely been dependent on, of course, traditional financial institutions, and they've also been dependent on, say, friends and family for their short-term borrowing requirements, right? And that's a very large percentage of audience, right? And these are short-term requirements which are not necessarily, they come with a very different kind of a commitment, right? They're not necessarily commitments which are, say, where there's which are not as institutionalized as, for example, what you would offer,
Absolutely.
right? Now, I mean, what has happened over a period of time? I mean, if you look at it, especially the ones operating in, say, tier 2 and tier 3, right, is essentially that they've built this mindset that, I'm going to have money from person A and then I'm going to be able to sort of channelize it to, say, a source B and so on and so forth, right? I mean, that's essentially how they're doing it. That's the mechanics of cash flow management, right? Which is, not necessarily build a very structured approach in handling finances, right? Is that while, of course, you're lending what you are, right, against a certain deliverable, which is very visible, right, which of course reduces your risk, right? But don't you think mindset still continues to be a huge challenge, right? Because these are people who've been playing that money management game, right? I mean, in a technical parlance, we used to call it bank, balance transfer, right, from a card A to a card B movement. But don't you think that is a complexity that you still deal with, right? Because while you could be extending money on a certain activity, I mean, that money possibly could be used, a portion of that money could still be used to say settle older dues. That risk still is there typically in that business, right? And which might not necessarily be very visible. And like you said, right, not a lot of, I mean, underreporting is massive, right? When you talk of SMEs, MSMEs, right? And that doesn't that becomes an additional problem in an environment like this, right? How difficult is it? I mean, how difficult is the mindset shift, right? I mean, are you doing something around that?
Yeah. No, good question, I think, Ashu. So the biggest thing that SME focused fintech, or especially a credit company which is in
Sure.
the lending business, needs to solve is the education of these small businesses around uh, financial literacy, as we call it, right? They need to be made aware that
Mhm.
this credit that they're taking is actually a loan, or is actually a financial instrument. Timely payment is important because it impacts their credit score.
Mhm.
Not paying it on time impacts their ability to borrow credit or loan in future. So we
Mhm.
have to do all of that. You're right that most of small businesses are in the business of rotating money,
Right.
right? They move money around from
Right.
source A to source B to
Mhm.
source C. But what we try and do here is, especially with this first product, is we make it closed loop, and we
Okay.
don't give money in their bank account,
Right.
right? So as you would have understood that this is a typical buy now pay later kind of a use
Right.
case.
Mhm.
You as a retailer want to order 2 lakh rupees of products from this marketplace, or let's say it's a distributor,
Sure.
right? In the offline world, we are directly going to pay the distributor,
Right.
and we are directly going to pay that distributor only upon confirmation of delivery.
Interesting.
So the whole process, or the whole reason of going via these online B2B marketplaces like Find, for example,
Right.
is the fact that we have a full API integration with
Mhm.
them, where the moment Find delivers,
Right.
they send an API response to us, and only when we know that it has been delivered, right, goods
Right.
have been accepted by the retailer,
Sure.
now we ask the lender to disburse the money
Mhm.
to Find,
Right.
right? Now the good part about all our relationships, not just with Find but
Mhm.
with every single marketplace or anchor that we work with, is if there are delays in payments,
Right.
we block the supply of this retailer.
Mhm.
While money rotation is a very critical part of their business, but ensuring that their supply is never stopped is also very critical for them.
Mhm.
So what we have been able to do is, with all our partners, we have an agreement that the moment uh, this retailer goes beyond, let's say, a grace period
Right.
and does not pay on time, we block him from making any purchases on this
Mhm.
platform.
Right.
Now, if there is a loose relationship between the retailer and the platform, then the retailer does not care. He'll say,
Right.
okay, I'll order from somewhere else. I
Sure.
have multiple other ways to order. But that's where our underwriting comes in, where we look at that transaction data in so much
Mhm.
depth, that we know that this retailer cannot survive or cannot continue his business if we stop his supply,
Mhm.
right? He's let's say ordering every week, every like thrice every month from this marketplace. So the moment we stop supply, there is going to be disruption in his business,
Mhm.
right? And we have seen that's the reason why our portfolio has behaved quite well
Mhm.
over the last 1 year, even in the middle of pandemic, second wave coming, and all that. That people have continued to pay us back,
Mhm.
right? Because they know that the worst thing that can happen at this time is their supply getting stopped,
Mhm.
right? So I think that is something we've used to counter some of these challenges that we have. But I think we still have to keep educating these guys. We
Yeah.
still have to keep, engaging with these guys, keep telling them that, hey, why managing your
Sure.
finances is important.
Right.
In fact, we are thinking of, should our next product be on those lines,
Mhm.
in terms of giving full visibility to this retailer
Right.
as to how you're moving money and
Right.
how you can better move money.
Right. Very interesting. And well, there's something very important that you highlighted, right, which is around consistency of demand, right, and as a very critical factor for you to go out and extend, right. Now, how do you get a sense of that, right? I mean, because my sense is, when you're in an environment like the one you discussed earlier, right, you typically are managing a portfolio of goods and products, right.
Hmm.
That can be many places. I mean, so Fine, for example, becomes one example where I could be sourcing just about say 20-30% of my, for example, that line of product, right?
Correct.
I think within that category it could be say 70-80%. But doesn't that limit the opportunity of lending for you? I mean, there could be a bigger play that you could add, but a relationship like the one you have, it only limits you to just consuming or just participating in the possibility of lending within that stream, right?
Correct.
Is that a conscious call that you've taken?
Sure.
I mean, I would love to understand a little more.
Yeah. No, I think there are two parts to it. You're absolutely right on that. Today, if we work with, let's say, one partner for a particular industry or for that target retailer,
Sure.
we are only capturing, let's say, as you said, 20% or 30% of his wallet. Right. So he's spending, let's say, 5 lakh rupees in a month on procuring goods, but only 1.5 lakhs is spent on Fine, and the remaining 3.5 lakhs is spent elsewhere.
Right.
He's still buying from an offline distributor. He's still buying from a couple of other places.
Right.
So it's a very conscious decision we have taken that we will start with capturing that 20-30% of his wallet, de-risk that customer. Because the problem is, even with credit bureau data and all that traditional underwriting, you still don't know the potential of a small business.
Absolutely.
There is so much volatility in small business. I mean, it's not like a salaried customer. You ask for a bank statement, you see that salary comes on the 5th of the month or 3rd of the month. So based on that, I can give you a debt. Right. It's not like that. So considering that there is volatility, what we've done is we've consciously decided that let's try and reduce that volatility from the equation by focusing only on a part of business that we are 100% sure of. So we know that, okay, 20-30% of his business happens through Find, and this happens on a regular basis. If we see that there is a retailer who, let's say, buys only during festive seasons from Find, and then he does not come back, right? So in a 12-month time window, I see there is one retailer who constantly buys from Find every week or every alternate week, versus there is another retailer who is, let's say, buying same value of goods, but once in 3 months, once in 6 months. It's no-brainer that my choice would be the first one to go after, because I can put with a lot of degree of confidence a limit to that customer in terms of how much exposure I can take for that customer. The next step, as you rightly said, for me is thinking, how can I now take 70% or 80% of his share of wallet instead of that 20%? Can I, after de-risking that customer, can I now go and offer him credit elsewhere as well? So today I'm giving him a credit on Find or any particular marketplace. Tomorrow, can I give him a credit on Udaan as well? Or can I give him a credit on his offline distributor as well? Can I give him a product which is universal, which does not require me to be integrated, which is like a credit card that he can swipe anywhere? Right. So I think that's where we are now thinking. And I think one of our products is already getting there, where we have announced a co-branded, it's one of the first in the country, an SME, pure SME, proprietor focused commercial card, co-branded with Axis Bank, which is coming out. And that product is an upgrade product for these retailers. So we consciously first do a closed loop underwriting of these guys, capture 20% share of wallet, de-risk them, know that these are the good guys and these are not so good guys. And all those good guys then get this credit card, which they can use anywhere. So now I have captured like 70% or 80% of their wallet. So that's how we are moving ahead.
Very interesting. Anubhav, I want to an offshoot of the earlier question that I asked you, right? Inventory overhang is something which is very, very critical, right? And like we discussed, right, they're not essentially either buying from that platform completely, or they're not completely supplying to one platform, right? Which is the other nuance of what you can possibly funding, right? Now, typically, what happens in an environment like that, right? And what has happened is that because of COVID, right? There's an added complexity, right? And I keep asking this across all of my conversations, right? Is that consumers' behavior there's a dramatic shift in the consumer behavior, right? I mean, the way they're getting influenced, right? The way they want to consume is just so much more dynamic, right? Today, an SME is not necessarily prepared for an environment like that, right? I mean, while the consumer demand just takes like a piece of content to, change their behavior, right, or influence them, SME will take forever to sort of react to that, right? The middle layer
Yeah.
is going to take possibly slightly lesser time, right? But it's exposed them to a very large risk of inventory overhang, which just puts the entire, credit possibility or the lending that you've done, not say directly, but through the structure, right, in jeopardy. What are your thoughts about that? I mean, how are you factoring in the consumer side risk, especially in a post-COVID environment, right, where the influence is just so much more thicker, stronger, right, and the credit models are not necessarily designed for an environment like this. I mean, there was like a little visibility that, of course, you had, you were operating in a very opaque market, but you still had a visibility in terms of trends, right? But in a post COVID environment, right, it's just become so much more dynamic, right? It's very difficult to anticipate, right? And inventory overhang is a very large concern. It's not necessarily being talked about, right?
Yeah.
But you talk to SMEs, you realize that they've not been able to clear their the inventories that they built, right, or they've brought or procured, right, because the appetite is shifted, the taste is shifted, right? What are your thoughts about that? I mean, how do you factor that in, right? I mean, are you seeing an added layer of risk that is getting built into this entire structure in India? Because the arbitrage between markets is also kind of going away, right?
Yeah.
What?
Sure. No, I think that's absolutely a fair point, because while we are today going after a retailer, the retailer's end uh, business or outcome is dependent on the consumers coming or landing at his shop, right? And that consumer is absolutely dynamic. That consumer, I mean, it's you can say that, but that consumer today has very little brand loyalty,
Right,
right? He tries to shop around, he tries to try new things.
right,
There is so much social media content out there. I mean, I can say it for myself that I have bought a few things that I had never thought I would purchase through an Instagram ad, right?
right,
And that's very, very smartly done today. There is so much
right,
of data analytics going behind what kind of an offer to show to a customer, that
right,
that customer is actually going for that and trying out new things. Now, because of that, obviously it is possible, and it's happening, that an SME who was typically seeing a certain trend
right,
of adoption by the consumers of, let's say, a particular SKU or a particular product for months and months, could
right,
suddenly see a dramatic shift uh, overnight,
right,
right? Where they would see that, okay, I was earlier not seeing low adoption for these kind of products, but now this inventory is just lying idle with me, right? So I think that risk we always run.
mhm,
But the good thing is that today, with all our partners, we try and get deeper, because we have that embedded relationship. We try and get deeper into that SKU level analysis,
okay,
right? It's not just a credit limit of 1 lakh to the retailer, where we say that, okay, buy 25,000 of goods tomorrow and get them delivered
right,
and pay us later. We also try and understand that what are those goods which you have been buying, and has your purchase pattern changed? So I'll give you
mhm,
a couple of examples.
sure,
So in agri, for
mhm,
example, uh, there are low margin products and there are high margin products,
right,
right? Now, what we typically do, and retailers are also smart, by the way, they also do this calculation at their end.
right,
But what we do is, with working closely with the marketplaces,
right,
we don't offer a buy on credit option on the low margin products,
okay,
because we know that this is a product where this guy is not making enough margin, and if the inventory is lying
right,
at his premise, then there is a tendency for him to not pay back,
mhm,
right? Because anyway, it's a low margin thing.
right,
He'll not be able to recover the
right,
loss. But if it's a high margin thing, we try and push those products on credit more.
right,
So that's something that we do, let's say, for the restaurants or for the kirana guys
uh-huh,
and so on. In agri, for example,
right,
a typical crop cycle, right?
mhm,
So a fertilizer, for example, is used at the very early stages of a crop
right,
cycle. A pesticide is used at a very late stage of a crop cycle,
right,
right? A fertilizer is a low margin
mhm,
product, right? So we don't normally give a fertilizer on credit,
mhm,
right? If, let's say, there is an agri retailer, when he's buying on credit, he'll not see fertilizer as an SKU that can be bought on credit.
Right.
But pesticides are, because pesticides, when they are being purchased, we know that the crop is ready. Right, or it will be ready in the next 1 month. So this guy will get his money and he'll pay me back. So I can still give him a pesticide on credit because I know my money is going to come back in the next few weeks.
Sure.
But I don't give that other SKU on credit. So I think it has to become a lot more smarter in terms of which SKU will finally end up lying in his warehouse and which will end up, which is a more fast moving consumer good, right? So I think in FMCG especially, this becomes very important. In pharma, we don't really care about this because most of the, all of the pharma brands, they have a return policy. I mean, whether it's an expired medicine or anything, it can be returned, right? But in other segments, we have to look at those kind of details. So we are now starting to get as deep as possible into SKU level behavior of these retailers.
Anubhav, I was in a very interesting conversation some time back, right? And that was with a very dear friend who's a restaurateur, right? And they have suppliers, right? There have been a bunch of interactions that they, for example, have, right? This is more like a case study that I'm talking about, right? Where some of the companies, who are into, basically, who, they were essentially in conversation with, right? To extend a line of, say, for example, credit possibilities in terms of payments to the, to the vendors that they have, right?
Right.
And the math was essentially that you don't have to pay anything, right? And whenever 30 days, 45 days, whatever credit period that you have, and then essentially then you start to sort of pay. Now, his argument in the process was that I'm in a negative working capital business. That's number one. Number two, my vendor has already factored in a 60-day free line of credit to me, right? I'm not necessarily, I have any obligation to pay whatsoever. Now, when you're talking of India, right, this is essentially the environment that exists, right? Where a lot of these smaller vendors, which will also qualify as, say, your potential target audience, right, have factored in, that 30-day, 40-day, 50-day sort of, credit period as the cost of doing business, right? What happens in an environment like that? I mean, is that a competition? I mean, how do you think the shift is going to happen to a more formalized platform like yourself, right? I mean, what are your thoughts around that? Because this is a very difficult shift, right? And a lot of, for example, this particular individual doesn't want to necessarily shift into an environment which is more formal, largely because of this reason. He's like, I am giving him business. He's already factored in that element, right? Or 60-day credit period, right? Why will I build those costs, right? And the arguments, right? What are your thoughts about that? I mean, that puts you in a very a tricky situation, right? I mean, that's literally something which is eating into your possible market, right? What are your thoughts about that?
Yeah, no, I think, and that was an issue we saw on day one. But what we also saw that, how commerce has evolved, right? You should see that when Bajaj Finance was building that large business that it has built in India, they offered this 0% EMI product to consumers, right? You buy a TV on 0% EMI, or you buy a washing machine on 0% EMI. How does that really happen? So basically, Bajaj does not lose anything in that equation. They get all their costs covered either through the brand, right? Because they are maybe helping an LG get rid of distressed inventory, the older brands, the older models of a television, or they get it from the retailer because the retailer has a good margin in that space, right? In SME also, like you said, distributors have always factored in that cost of 60 days of credit, when doing business with small retailers, because small retailers always expect that I should be able to enjoy a 15, 30, 45-day, 60-day credit line. When B2B commerce started becoming digital and all these players started coming in, the ones we talked about, like Find and Udaan and everybody, they knew that from a product pricing, assortment, quality, supply chain perspective, they were much better than an offline vertical because they were removing intermediaries and all that. But the biggest thing that would drive a success for them that they understood on day one was credit. That for the offline guy to shift digital, they have to offer credit as a hygiene factor. And that is something that a lot of these digital players have also built in. So today, our products Ashu, are all subvented products. So this retailer does not pay anything for that 15, 30 day, 45 day credit, right? To the small retailer on Find using, let's say, a Rupifi pay later option or a Rupifi BNPL option, it's a 0% cost. It's a free credit option, right? And I don't know whether that's long-term sustainable or not, whether these B2B platforms have enough margins to sustain that or not. But I think considering that we are right now putting the offline world against the online world, I think it's become like hygiene, and we can't escape that. In fact, with one marketplace, we tried not subventing this. And they said that, guys, we don't have enough margins. We can't subvent 30, 60 day costs. So you charge the retailer directly. We saw that there was very, very low adoption. The guys were not ready. They were like, hey, we will not buy from this marketplace if you are charging us 1% or 2% extra for this credit period, because my distributor is giving me free credit. Right? I'll go to him. So I think that's the mindset that is there today, and it's very, very difficult to change it because it has always been there. So what a lot of these digital players have to figure out is they have started to bake that in their cost as well. And now they're thinking, how do I monetize this through some other means? And that's where lending comes in, where now they are saying, okay, can I give growth capital to this same retailer? Because for that, the guy will pay, right? For his procurement financing, he'll not pay. But for growth capital, you can always charge him. And these guys are better placed. So I think more embedded lending products for us, more business for Rupifi is how I see it. but yeah.
I think early days, Anubhav, and I know there are no clear answers, right? I mean, I think it's something that take time. I think it is a complicated thing. We are a large ship, right? I think we can't let go of that fact. I think we have to factor that in. Anubhav, one very large problem, right, which is there in the lending ecosystem, especially when you're doing it across SMEs, MSMEs, right, is the possibility of recovery, right? I have personally experienced it at an agri level, and it's madness, right? I mean, it's so difficult, I can't even tell you, right? But what's your sense? I mean, what are the recovery trends here? I mean, are they, and given there is lack of visibility, right, across their P&Ls, across their balance sheets, right? A large part of transaction is still happening off the books, right? How difficult is it? How difficult is the recovery process, right? Even with the platforms, absorbing a certain portion of your risk because you're doing a closed loop sort of a transaction, right? How difficult still is the recovery process? How complicated? Not difficult, but how complicated is the recovery process?
Yeah, I think the most complicated or the most challenging part of our business is to build that collections and recoveries model, right? And that's where I think it becomes slightly unsexy, as you may call it. But that's where the value creation happens. A lot of founders have spoken about this time and again, that if you are doing something which is difficult and hard to scale, I think that's where the business has to be made, right? So I think we have also focused on collections right from day one. Ashu, we've tried to, and I won't say we have cracked it completely, but I would say we've looked at it with multiple lenses. Especially because we are in small tickets, we are in smaller SMEs, so we can't really deploy physical ground staff to collect. I mean, that cost is exorbitant, right? We can't afford to have manpower going to every single retailer collecting small ticket sizes, right? It would not make the business model viable. So we've tried to solve it through technology. We've created multiple multi-channel collection systems where we reach out to the same customer through SMS, IVR, WhatsApp, call, various other modes, right? Blocking him on the merchant app, sending him notifications, various other ways we try and contact. And I think there's still a long way to go in that. But I think collections is the toughest part of this business, because think of it from an attitude perspective. How does an SME behave? Let's say you are a vendor and another business raises an invoice to you. Even if you have money in your bank account, you will still delay that payment. Right? That's the typical Indian business mindset. That he will tell his finance guy, make that payment after this guy comes back to you at least 2 times asking for that payment. I mean, why do we have to follow up on our payments? Why can't that be a straight through process? But that's a typical business mindset, and it takes time to change mindset.
Right.
You can't change behaviors overnight. So we are thinking of incentivizing timely payments.
Right.
We are thinking of, instead of penalizing late payments, how can we positively reinforce good behavior?
Right.
So a lot of this is a typical HR theory that a human, you can have a negative reinforcement,
Right.
where when somebody does something you wrong, right, you try and punish them.
Right.
But instead of doing that,
make them the monitor.
Yeah. Exactly. Here, instead of doing that,
Right.
you try and push good behavior,
Right.
and try and give them an incentive. In fact, Kunal talks about this when he talks about cred, right? That we are building a community of people who are doing good, who have good credit history, who have good credit behavior, and we are trying to give them more incentives. We are trying to give them more and more value for being good guys, right? I think we also have to follow a similar approach when it comes to SMEs. That if an SME, let's say, pay their credit on time, can we give them an incentive to do that again, right? I think that's something we are working on. It is going to be a very, continuous evolution of how we build these recovery and collections process.
Right.
But we're definitely working on that.
I would want to understand one more thing, right? I mean, and given that this is not a direct relationship, you're essentially working as you're closely working with another platform, right? And essentially the platform is front-ending it for you, right? Yes. So you're essentially the back end of that platform, right? And you don't have a direct relationship, right? How complicated does that make the entire process of communication and recovery, right? Because, if I'm a platform, I'm going to be extremely sensitive about my relationship with my client, right? I would not want it to go back or bad, right? Because, after a lot of pain and a lot of cost, I've acquired that customer, right? And I want to continue. My quest as a platform will always be to continue to build that, that long-term value, right, of association with that customer, right?
Yeah.
What is a degree of complexity that comes with an environment like that, right? Where you're not, you might just cross into a territory without necessarily knowing about it, right? And that there could be a relationship that could get hampered in the process, right? How do you sort of manage that, right? How do you keep that balance when you are in that process of recovery? And I understand recovery is an extremely difficult process. It's not a great conversation, right? It's not a great environment. And like you said, right, it's not a sexy place to be in.
Yeah.
How do you operate in that given that there is a sensitivity around that relationship?
Yeah, no, I think so. What we need to understand, Ashu, here is that how does this whole embedded finance thing work, right? As an embedded lending partner, I think what we are agreeing to do is we are agreeing that this is my partner's customer. Okay. So any communication that we do, we try and front end using their name. Okay. It's always easier for me to collect money saying, I am from Find and I am trying to collect money for your Find credit line, which was given to you by Rupifi. Instead of saying that I am from Rupifi collecting money for the credit line I have given you. The guy may say that who is Rupifi, right? I don't care. So I think from that perspective, we try and front end a lot on our partner. We piggyback on their name a lot because we understand this is their customer. We are a technology backbone for this entire lending product that we have given, whether it's a credit line, whether it's a term loan, whether it's an invoice we have discounted, whichever product we are given, we've given it to a customer of a partner. So, we are a more B2B company or a SaaS company in that respect. And because of that, the end customer of the company where I'm providing a SaaS solution, right, will always remain the end customer of that partner, right? So we have to be very careful, and it becomes tough during collections, as you said. But it also becomes easier when I use their name,
right?
Because I'm able to collect faster by using their name rather than saying I am from that NBFC, I am from that bank, or I am from Rupifi, and I'm collecting this. Unless we are a multi-billion-dollar company and everybody knows Rupifi, which is in the next 5 years, and there is a brand created. I think till that time, especially in the embedded lending model, we are far we have far easier collections and recoveries where we go as a partner to the anchor that we work with.
Interesting. Anubhav, I'm going to move a little away. I think we've discussed a lot about in the consumer side of it, the risks that are there, the credit model that you have, right? I think we've talked a lot about that environment, right? What I want to talk now about is basically the funds, right? And how are you structured as Rupifi, right? I mean, are you a co-lender in the process? Are you enabling financial institutions to lend through your platform where you're doing, the credit assessment, you're doing like a lot of that work, understanding, and then essentially is an FLDH arrangement. I mean, what is the current construct of your relationship, with other financial institutions?
So we have been very clear from day one, Ashu, that we don't want to become a lender ourselves.
Right.
We are not the balance sheet here. We are a pure technology API interplay between the supply and the demand, right? And we own the product. So what we definitely do is we create the entire customer experience. We create the entire product. We have a risk sharing with the lending partners, but we don't co-lend. We don't give our balance sheet there, right? How that helps is it gives me a lot of leverage.
Right.
Even if I have to do, let's say, a risk sharing arrangement, some kind of a guarantee arrangement with the lender, I still get 20, 25, 30x leverage on my equity, right? Which is very important for me to scale this business. So I think we are very clear. We'll not, a lot of people ask us, investors ask us, have you applied for an NBFC? Will you be going to apply for an NBFC? Are you doing like 595 kind of a co-lending? And we are not doing any of that. I think because for us, the moment we do that, then we also believe that we will never be able to do a pure play marketplace for these platforms that we work with, right? SME is a very heterogeneous segment. Not one lender can serve them. Today, the beauty of our model is we are multi-lender, right? So when we go to a find or when we go to any such B2B platform that we work with, we tell them that, hey, we are bringing these 5, 6, 7 lenders with us. You don't have to talk to 5 different banks and NBFCs for your customer base. We give you maximum approval rate. We give you maximum coverage because we have a line of lenders that we work with. The moment we become that one of the lenders, I think that's where the conflict starts happening, right? So we are not getting into that.
Very interesting. And typically, vis-a-vis a regular institution that SMEs have to deal with, right? In an environment like that, how quick is the transaction, right? I mean, how are you, for example, what we are kind of, what we are seeing is literally, a very, very short time duration, right? When it comes to, say, extending that line of credit, right? In your case, how quick is that, right? And of course, basis you have a transactional data available. Are we talking about a 30, 40 minute, an hour and a half sort of a time frame, or are we talking about a slightly longish time frame? Because, like I said, you don't have an access to the complete portfolio. You essentially are operating in a certain percentage of the portfolio, which is being, kind of consumed from a certain platform, right? How quick is that, turnaround? I mean, how quick is that process?
So the first one-time onboarding that we do is an instant activation for most of the customers, barring a few customers, let's say, who are not able to complete the digital KYC journey, or who are not able to complete the 3 or 4 step. It's a very simple journey that we have for onboarding a customer. But let's say, because these are SMEs, they're not the very well, some of them are not so well educated, some of them are not so digitally savvy. Some of them may not have complete clarity of what we are asking. So there is a team that helps them complete that journey, right? Now, that may take, let's say, a 24-hour kind of a period for them to get onboarded, but 80% of our customers are onboarded almost instantly. Once onboarded, the transaction is a real-time process. So there is no lag. You go, you select products, you go to the checkout page, you select Rupifi. Instantly, we push it to the lender. The lender gives money to the marketplace. Delivery happens. Everything is on a real-time basis.
Very interesting, Anubhav. I know it's been, this is been a very, very deep focused conversation, right? We're towards the end of the conversation. Last, couple of questions that I have, right? What is the commercial model and commercial arrangement that you have, right, on either side, right, with your partners that you're lending with and with the financial institutions, right? What's that zone that you are playing in? If you could share a little more, if you could give us a little more insight on that, I think it'll be interesting.
Sure. So, as I said, this is a subvention model. So for every credit that we extend, the partner that we work with, there is a subvention income that we get, right? Now it's very simple. Let's say we get X rupees as subvention income. After factoring for the cost of funds that we pay to the lender, we need to make money. So that's how this works. Our revenue biggest head is the subvention that we get from the partner, and the expense, the biggest, is the cost of lending that we pay to the balance sheet provider, right? Whatever is left between that is basically the income for Rupifi, right? Other than that, we also have some fee income for the platform that we've created, for the tech that we've created. We definitely charge a subscription on that, so that's also an income source for us. But that's currently small because we are new. I think as we scale, that technology subscription fee may become larger, and the per transaction subvention minus cost of lending may become a smaller share of it.
Interesting. Anubhav, how I actually want to sort of, I mean, this is, like I said, this has been a long session, right? And this has been a tiring session in a certain common way. I would have loved to discuss a little more on, usage of say deep tech. A lot of ML, for example, is being used, right, in terms of your credit rating, and that's something which I think every fintech is now kind of talking about adopting, right, very quickly, because I think that everybody's trying to essentially sort of minimize that time period, right, and factor in many other variants and factors, right. But I think we're going to save that for the next conversation that we have, and hopefully soon, right? But Anubhav, like I said, we're towards the end of the conversation, right? What's been that one or two moment, right, when you and I'm sure as a founder you must have sort of experienced this. You entered the market into a certain thought process, saying that this is what we're going to do, right? And when you hit the market running, right, you realize that this is not possibly how it's going to play out, right? We'll have to sort of say pivot, we'll have to reposition ourselves, we have to repackage ourselves, right? Was there a moment like that which kind of brought in a very different kind of a realization around the Indian market? And like I think we discussed, right? We're a fairly complicated market in that sense, right? Was that a moment of realization that we'll have to cut it in a different way? This is not how it's going to work.
I'll call out two things here. Tough spots for us during the last 1 year. So if you see, in India is a very price sensitive market, right? We were talking to one of the investors, and we run this program. Now, when we go to a marketplace and we say we are giving 14-day product to your retailers, it's a 14-day subvention.
Right.
If I tell them that I'm charging 1% or 2% for that 14-day, there is a tendency for every marketplace to annualize that and say, okay, this is this much annual rate of interest, right? It's actually not. You should see it in a way that if you have 100 rupees today, that you are doing a sales of 100 rupees, you are incurring, let's say, a cost of 1 rupee.
Right.
You should not look at it as a 24% cost. Right. Because now that same 100 rupee, you can rotate faster and actually make whatever margins you are making 24 times in a year. Right. But there is always that tendency that, okay, 24% is high or 30% is too high. I'm expecting it at 14%. That's where the market is. And it's a big challenge. I was speaking to an investor in US. He said, Anubhav, the same product, even though in US the cost of lending is half of India, is being offered at twice the rate of what it's there in India. You just can't make money if you continue to operate at these rates. You should come to US and do this, and you will have a lot of money to be made. And we kept thinking that, are we in the wrong market? But then we finally, got to understand that, hey, we need to position it differently. We should position it as a product which is more a feature or a service which enables a transaction and not really a lending pure play, right? So it took some time to change that mindset, right? There was also another problem that we faced where these marketplaces asked us that, hey, you have a simple journey. Can you make it simpler? Don't collect KYC. I was like, how can we do that? It's a regulated, a regulated industry. But then, again, we looked at the US, BNPL, cash advance, some of these products are unregulated there. So fintechs actually have gone and scaled to crazy volumes without getting into this whole burden of doing KYC and, signing loan agreements and worrying about compliance from an RBI perspective and all. In India, even the simplest credit product is heavily regulated, right? Now, that's good and bad at the same time, right? It curtails innovation to a large extent, but it also makes sure that there's not undue noise
Right.
in the market. So I think those were some phases where we thought that, hey, are we in the right industry or
Right.
are we in the right market?
Right.
It's so heavily regulated and there is so much price pressure.
Right.
But I think those are days that we've gone past now.
I think I kind of agree with what you're saying, and I think I understand. I mean, honestly, I think at a policy level, I mean, I've been in the financial ecosystem for a reasonable amount of time, and I think the challenge really, Anubhav, is the lack of financial literacy. I think that's a massive problem, right? And I think it becomes government's kind of a duty and a prerogative to essentially ensure that large part of that large part of the citizens are kind of safe and secure, right? They're not really taken for a ride, which I think can happen so quickly, right? And I
Yeah,
think still adopting to the digital ecosystem, right? In terms of
yeah.
like I said, consuming content, right? To build that awareness. I think those are challenges that we kind of see in our economy. And above, last question, right? What are the next 2 years like? You put in a lot of effort, a lot of hard work. I had the opportunity meeting you when you were raising the capital, right? From that to today, I think it's been a phenomenal journey. I think the kind of ground that you covered is absolutely amazing, right? What are the next 2 years like, right? What are you what's keeping you awake, right? What's keeping the team awake? What are some of the things that we're going to see in the next 2 years?
Sure. I think so. Some of those we've already talked about, Ashu. I think
Sure.
one is how do we crack recoveries and collections as a
Right.
process. We are in a credit kind of a product ecosystem.
Sure.
Collecting money is always difficult. Lending is easy,
Right.
right? So I think we need to sort that out over a period of time. We are still building on it, and we'll continue to build on it. The second thing is from the market. If you see B2B transaction universe is very, very nascent today.
Right.
UPI has completely changed person to person transactions or P2M transactions,
Right.
but B2B largely remains offline. How can we digitize it?
Right.
Is there something that the government can do? Can we work with the policymakers to change it? I think those are areas, because B2B is somewhere government also comes in, right?
Right.
They do a lot of transactions themselves
Mhm.
with businesses, and we are trying to see if that could be a starting point
Right.
for this. So the next 2 years for us is more around using some of the public infrastructure, working towards changing some of that, setting good examples on those lines. And from a business perspective, how do we move from 20% share of wallet to 100% share of wallet? How do
Right.
we do better collections? I think those are certain areas that we'll work towards. Also transition from a purely online to a online plus offline multi-channel approach. I think that's very important in India.
Right.
You need to have that.
Right.
You can't just say that we are an app and everybody will use the app.
Right. Anubhav, I was in a very interesting conversation yesterday, right? And that gentleman runs like a physical infrastructure across 250 cities, right? And he's been doing that for the last 32 years, right? I mean, and you know what I'm talking about, right? And this is essentially what we kind of discussed and discovered, right? That you
Yeah.
will need physical infrastructure beyond a point. I mean,
Yeah.
India is a touch and feel market, and that's not changing in the next 5, 7, 10 years, irrespective of whatever said and done, right?
Absolutely.
And
Absolutely.
I think eventually for a lot of fintech players, they'll have to look at that infrastructure, right?
Yeah.
Either their own or as their partner, right?
Yeah.
But I think whatever said and done, I think it's going to be an interesting time, right? I think fintechs are really changing the landscape of how we consume as individuals, as businesses, right? And I think slowly and steadily, but I think that shift is coming in. I think people are getting more responsible, and I think it's just a matter of time before a lot of this consumption shifts onto more institutionalized formats, right? Which make it
Yeah.
very visible and and take away the opaqueness that sort of exists, right? And I think the predictability kind of improves, which essentially means it's going to be a better operating environment for players like you at Rupifi and many others who are on in the ecosystem.
Absolutely.
Anubhav,
Absolutely.
thank you so much. It was a
Thank
pleasure
you
to
so
have you.
much.
Thank you for this.
Yeah. Equally my pleasure. Thank you so much, Ashu.
Thank you.
Thanks. Thank you for having me.